Welcome back. We will now look at the liabilities and stockholders' equity section of the balance sheet. As we said, while the list of assets is the list of what the company owns, then the liability and stockholder equity is what it owes. The first category are liabilities, which essentially are, you could say in short, debt that in various forms that the company has towards other actors in the economy. And stockholder equity is the list of investment made by shareholders into the company. Liabilities are also ranked according to their maturity, just like the assets. The less or the more mature, which is about to be sort of liquidated, are the account payable. Account payable is what the company owes in the short term. It has to pay in the next quarter $800,771,000, and that will be taken off the bank account. So it's very mature. Then they may have account payable in period 10. That's what they have in Q2. Then comes supplier credit. Supplier credit is money owed, but that the company has not been able to pay and for which it got a special credit at a high cost provided by the bank, and that will be paid immediately in the next quarter. They have a supplier credit. This company has a supplier credit in Brazil, and it has also a supplier credit in Liechtenstein, and the consolidated is this much. So this is essentially the sum of these two. They have no supplier credit in the US and Europe, which is good. Then they may have, or you may have area bank loan, which is what this company has. It has $3 million bank loan in the US, $3 million bank loan in the US. And then we come to current liabilities, which is the sum of all liabilities until this point. Now, this line is important because as you try to get a loan, a local bank loan like this one, 3 million, you request an amount, but that amount has to be proportional to your net working capital, which is the difference between current assets and current liabilities. So here they had 10.3 million current assets, 3.8 million current liabilities. So they have well over 6 million net working capital. Depending on the area, you are entitled, if you so request, to have a local bank loan of up to 50, 60, 70, 80% of that net working capital, depending on the area. Then come other loans that are more long-term, but they are mostly, exclusively, in fact, in the home office. Intercompany loans are always between home offices. Bank loan from another company or from the Bank of Liechtenstein. Long-term bonds, these are long-term liability. Then they have none in this particular case. Then comes the other section, which is stockholder equity. So that's the amount of money that has been invested by owners, by shareholders. As you recall at the beginning of the simulation, you are getting 20 million Swiss francs, and that is the common stock at par. Paid in capital, which is the second line, would be some money that your shareholders are actually paying into your equity because they are satisfied with the return they get in terms of dividends. So if you pay dividends, you're likely to get a little bit of that money back into some more investment, but don't count on it to raise your equity by a large amount. This is really marginal. Then comes retained earnings. Very important, and we put it in purple because this is one of the criteria like supplier credit on which you're going to be assessed in this Intopia simulation. Retained earnings are profits that you have kept into the operation, they have retained into the operation, and they can be, of course, positive or negative. If you make a loss, well, by definition, you have to retain it. But if you make a profit, like in this case, in Europe and the US, you may decide to distribute it in dividends or retain it in the company, in the operation. In this case, you could not really do it because the accumulated retained earning to this point, that's what this is essentially saying, is still negative. Not by a big margin, only like 200,000 Swiss francs, not very much, but you cannot pay dividends from the home office to shareholders if you have this negative retained earnings. However, you could have moved retained earnings, repatriate retained earnings, that's a form of dividend payment to the home office. It would change the situation in the home office. It wouldn't change the consolidated because it moves from one pocket to the other and your total wealth is not changed. Then home office control, I mentioned earlier, home office control over here is what this company home office has invested into the various subsidiaries. So it has invested $7.4 million in the US, roughly $1 million in Europe, and about 4.3 million reals in Brazil. So that's what this company, these different subsidiaries have as like their local equity. Then unrealized loss is essentially a potential loss that this company would incur if it was to move back some money that it has invested in the different areas. So, well, suppose I buy $100 and I send it to the US, and then I perhaps transfer this back into Swiss francs. That will cause me a loss of this because in the meantime, probably the euro has gone down in terms of value relative to Swiss francs. That can happen in any areas. You buy a currency, that currency devalues. When you buy back that currency, or when you buy back your Swiss francs rather, then you would incur a loss. As long as you keep this currency, then this loss is still unrealized, it's still potential. Total equity is the sum of everything, and then of course total liability and equity, which is by definition total to the total assets. Total assets here are 38 million, and then total liability here are 38 million.